India's Goods and Services Tax Council has just delivered one of its most significant overhauls since GST was introduced back in 2017. And this time, the changes are not just about simplifying tax slabs. They're about giving a fresh push to India's consumption economy, boosting investment sentiment, and possibly reshaping the stock market narrative. So, let's break this down. The council announced rate cuts across several key categories: automobiles, electric vehicles, gold, mobile phones, and select consumer durables. For example, EVs and hybrid cars are now cheaper thanks to reduced GST, a move clearly aimed at pushing India closer to its clean energy and sustainability goals. Gold, one of the country's most prized assets, saw rate tweaks intended to curb smuggling and encourage formal trade. Even cigarettes and tobacco products were hit with higher GST cess, signaling a health-focused approach. At the same time, some luxury or sin goods saw an increase, ensuring that revenue neutrality is maintained for the government. Essentially, this GST reset is a balancing act, lowering costs for high-consumption goods while ensuring that the exchequer doesn't lose out. Now, let's check out the impact on consumers. For the everyday Indian, the first reaction is simple. Will my shopping basket get lighter? For cars, bikes, and EVs, yes. You may see prices fall in the coming months, giving a boost to the auto sector just before the festive season. Smartphones and electronics may also become slightly cheaper, driving up sales for brands and e-commerce giants. On the flip side, smokers and luxury buyers might feel the pinch. But the broader picture is this: GST compliance becomes simpler, cascading taxes reduce, and more trade shifts from informal to formal channels. This means higher efficiency and lower leakages in the system, which in turn benefits the economy. How do the business and industry respond? Industry bodies and trade associations have largely welcomed the changes. The automobile industry is celebrating. Companies like Tata Motors, Mahindra, and Maruti Suzuki could see higher sales as price-sensitive consumers jump back into showrooms. The electronics sector is also expected to gain, especially in Tier 2 and Tier 3 cities, where affordability drives growth. On the other hand, FMCG players are cautiously optimistic. Lower input costs and rate cuts on certain raw materials could mean better margins. But companies are waiting to see if consumer demand actually translates into higher volumes. Let's check out the stock market response. Now, here's where it gets exciting. The day the announcements were made, markets cheered immediately. The Nifty 50 crossed 24,700 points, and the Sensex surged by more than 150 points. Auto and FMCG stocks were the biggest gainers, with investors betting on stronger demand in the coming quarters. Shares of companies in the consumer durables and electronics space also saw buying momentum, as traders expect a bumper festive season. Even gold-related stocks and jewelry retailers like Titan saw positive movement on hopes of stronger legal trade volumes. But not every sector was smiling. Cigarette maker ITC, for instance, faced investor caution after GST cess on tobacco products was raised. Similarly, some luxury-focused firms saw muted reactions. What could be the bigger economic picture? Beyond the stock market, economists see this GST reform as a consumption booster. India's growth story has been slightly dampened by inflationary pressures and sluggish demand in rural areas. By cutting GST rates on everyday consumer goods, the government hopes to spark demand at the grassroots level. This also fits into the larger political and economic strategy. With major elections around the corner, tax cuts on essentials and big-ticket consumer items could translate into both economic momentum and political goodwill. What are challenges and questions for India? Of course, there are concerns. Will these rate cuts actually reduce prices, or will companies quietly absorb the benefits into their margins? Will the government's revenue collection take a hit in the short term? And more importantly, can GST reforms alone drive long-term growth, or is this just a short-term boost for markets and consumers? Economists warn that unless paired with job creation, wage growth, and rural demand recovery, the GST reset may not be enough to sustain momentum. So where does that leave us? For now, the new GST rules have clearly lifted investor sentiment and given the markets a bullish push. Consumers are hopeful for lower prices, businesses are recalculating their strategies, and the government is projecting confidence in India's growth trajectory. But the real test lies ahead in whether these tax cuts and reforms can truly translate into sustainable demand, stronger corporate earnings, and long-term economic resilience. For now, India's GST reset is more than just a tax reform. It's a signal of intent, a nudge to the markets, and a reminder that in an economy like India's, even small rate cuts can trigger a big wave of change.